Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is Getting Started with Options. And today is a viewer request. I was going through the YouTube comments earlier today on another video, and I saw a question here. The question was, hey, Coach Cam, can you have a class about managing a credit spread by percentage? So yes, it's exactly what we're going to be talking about today. We're going to be planning the exits for a credit spread using profit or loss percentages. It's an approach that's quite common in this strategy, but for some traders, they like to predefine their reward potential to the fullest extent possible, but also that risk. So we're going to be planning and placing an example credit spread with percentage exits, both positive and negative. Should be a great discussion. Before we get to any of that, though, we first of all say hello to everybody. It's already chatting in out there on YouTube. Hello there, Mighty Mouse and Robert, Will, Jackson, Frank, Greg, Josh, Eva. Let's see, who else is here? Steve and Terry and Kevin and Tony and Lawrence, and on that list goes. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, we'll enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Tuesday webcast series. We kick things off promptly at noon Eastern time. Now, I also want to let you know that my very good friend James Boyd is going to be hanging out in the chats. He's going to be addressing any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, James. And James and I would like to issue an invitation to everybody watching. If you have an account with X, you should be following your favorite presenters there. Best place to connect with us in between these live streams. You can find James there at James Boyd CS. You can find me there at Cameron May CS. Let me just check one other thing. Bear with me for just a moment here. Yep, it looks like we've addressed everything. So let's talk about something really important, risk, and then we'll set an agenda for today's discussion. So risk is real. We need to bear these important disclosures in mind. So the information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for the day. As I mentioned, we're addressing this viewer request. We're going to be talking about exiting using percentages, planning in advance what profit might be suitable for the trader, what loss they're willing to accept, and then automating that process to the fullest extent possible. So we're going to look at the markets first. We'll take a quick peek at the S&P 500. Then we're going to plan in place an example credit spread trade. This is going to be a bull put credit spread, but the same sort of percentages might also be used for a bear call credit spread. And then we're going to put that order into action using an example trade on our thinkorswim paper money platform. So let's go right to thinkorswim. And here's the S&P 500. It's another banner day for the S&P. We are pushing. Are we sitting right at? Yep, that's above previous all-time highs. We're at 64.28. This from just about 8 trading sessions ago, we got up to 64.27. So we're 1 point above previous all-time highs, setting records even as we speak. Let's say that our hypothetical credit spread trader out there is just looking at the momentum that the market has. They're planning a trade for out here in September. Maybe let's go out to the September 19th expiration for our example trade today. And let's say that our trader just thinks that prices are more likely to continue to rise than to fall. Now, obviously, as we get deeper into summer, start moving into fall, things could course correct. Markets can turn on a dime and head down. But today we're going to be planning and placing an example bullish trade, just sort of with this as our backdrop. All right, so let's go right to an example stock. So I'm going to be doing our trade example on Bank of America. And of course, before we dive into the trade specifics here, I think it's only natural. Somebody's going to say, hey, how did you come up with this stock? Why was this stock selected among the literally thousands of stocks out there? Well, for options traders, I'm going to address that audience specifically. For options traders, they can have a number of their own specific personal priorities, but one that tends to be a wide common thread is liquidity. Now, not every options trader pays attention to liquidity. I think sometimes to the detriment of some traders. But when we have a stock that's illiquid, its options tend to have even poorer liquidity, and that can lead to very wide spreads between, let's say, the bid price and the ask price. It can make it harder to get into those options, harder to get out of those options. It can make it just more difficult to trade those profitably. And profitability is not a guarantee right from the start. So one potential obstacle that might be mitigated is to look for, at least to some extent, to look for highly liquid stocks. Bank of America happens to be one of the largest companies in the world, one of the most liquid companies in the world. So that was one qualifier. Another thing that I'm going to be paying attention to today is the price per share. Trading these low double-digit stocks from an educator's perspective just makes the math easier. Instead of trying to follow the math of lots of numbers, we're going to be having smaller numbers to deal with. So that makes it easier to teach the concepts. Now, traders do commonly pay attention to the price per share. High price stocks will tend to offer more options to choose from, more strike prices to choose from, so the strategy can be tailored more specifically to that trader's outlook. Low priced options won't have quite as many to choose from very commonly, but also the associated risk exposure can be smaller because the price per share in the form of obligations, when we're selling options, it's a smaller obligation. So there can be trade-offs. Exclusive says, what does liquid mean? Liquid literally means the number, and thanks for asking the question. It literally means the number of shares for the stock that are trading on a daily basis, or the number of contracts for the options that are trading on a daily basis. Lots of stocks, we say that that's a liquid stock. It means that you can sort of flow more smoothly into or out of that stock if you think about it that way. Same deal with options. When they have lots of contracts that are trading, we might think of that as more liquid. It's smooth. Think of it as a liquid as just flowing more readily. Does that make sense? I hope that does. But that's it. It's a reference to volume, whether there's lots of trading volume or relatively limited volume. Exactly right. Thank you, James. Yeah. So Bank of America, price per share, liquidity, another potential consideration for those who use charts in the planning of their options trades. Maybe they like to look for something that seems to indicate, in the case of a bullish trade like we're going to be doing today, has the stock been behaving bullishly, and does it appear to be behaving bullishly right at the moment? And here's what Bank of America has been doing, just like so many stocks out there, that starting right around that second week of April, it really started to charge higher. Now, most recently, it's come back down to an apparent price floor. You'll notice there was a price ceiling transitioning to a more recent price floor right around that $45 level. You can see the stock really never closed above 45 for a stretch of about 8 weeks. Finally pushed up and through that, and then it's as though traders have been reluctant to go back down below 45 since then. So that old price ceiling seems to be acting as a new price floor, possibly contributing to continued bullishness from here. It could turn right around, go break right back down through that floor, but for some technicians, this is just what they might be looking for as an indication of continued bullishness. Now, there's another thing that's happened here. This was actually a recent question that I had on my X account, formerly known as Twitter. I posted, hey, with these big gaps down, I asked my followers, do you typically see that as a warning sign or as potential? And in this case, we had our gap down. We gapped down from about just under $48 down to about 46, and then we continued down to about 45. But one technical assumption by traders is that if we're able to get back inside of this gap, what we call the gap window, maybe that window will fill. Kind of interesting to me that the high of today's price coincides pretty neatly with the low of the top side of that gap. So here we have a gap fill event. So let's add this up for a technician. Maybe they see the stock had been going higher, recently came down to a support, then it's moved into a gap, and this could signal that this is starting to run further. So for some technicians, for some chart-oriented traders, they may look for these sorts of things. Now, if you're not familiar with charting in general, I actually do teach a webcast every Friday. It's called Advanced Charting Techniques. You're certainly invited to join me in that if you feel like you need to brush up on your charting knowledge. But let's just say that our trader here sees bullishness on Bank of America, and they think this momentum is likely to carry the stock higher. And there are lots of option strategies that might be employed to pursue reward potential under that assumption. If we're bullish, maybe we could, let's say, for example, buy a call, or the trader might sell a put. Selling a put is also a bullish strategy. So we're going to be doing something on that theme. We're going to be selling a put vertical spread. So let's go build a put vertical spread. And then we're going to plan the exits for that spread to manage profit potential and also hopefully to manage the loss potential. So let's go to our trade tab, make sure that we're looking at the BAC option chain, Bank of America option chain. And let's go out here to the 19th of September. That's the time frame that we've been using. I didn't spend a lot of times, explaining, how is a time frame selected for a trade. I'll leave that for another discussion. I've actually addressed it in the past. If you want to see previous webcasts on a given topic, make sure that you have subscribed to our Trader Talks channel. So you can go down and click on the subscribe button down in the lower right-hand corner, or click on subscribe down below the video stream. But Trader Talks Schwab Coaching Webcast is the name of our YouTube channel, and you can find our previous webcast right here under playlists. So for example, I could click on playlists, and I could scroll down to getting started with options. It's toward the bottom. Let's go down here toward the bottom. And it's going to have Barb's face on it. She recently filled in for me in this webcast series. But if we click view full playlist, we can go down through this list and just look for one that focuses more explicitly on expiration selection. All right, but let's go back to our trade here. And I'm going to align the strikes that we select with what we saw on our charts. Jeff says, are you able to close a trade straight from the chart? We can, Jeff. Yep. I'll see if we get a chance to demonstrate that today. I'll just let you know that, yes, that can be done. But in any case, let's align our strike selection. So it looks like we have the gap was right up here above 46. And there's a support, an additional support down here at 45. So what I'm going to do for today's trade, let's say that we sell a put at 46 with a put, and we're going to carry that out through the September 19th expiration. With a put, the general objective of the trade is for the stock to stay above that strike, get to expiration, and hopefully the contract just expires worthless. Now, to help us with the downside risk of that, in case the stock starts to misbehave and goes down, we might buy a lower strike put. And how about in this case, let's buy a put down here at 45. So if the stock does come down, maybe we'll just bounce off that 45. If it falls below 45, though, what we've done here, by selling a put, someone has the right to sell us shares for $46. By buying a put, we have the right to sell those shares to somebody else for 45. It's going to limit the theoretical risk on this trade to not more than $1. Okay? So here's what that's going to look like. Let's go to our trade tab, and let's outline our example trade. This is a bull put spread. It is done for a credit. It's also known as a credit spread. Let me just expand this margin out a little bit so we can fit this all on one line. And it begins conceptually with the short option that we're selling. So we're going to sell the 19th of September $46 put. And right now that looks like that's trading around 75 cents, 75, 76. Let's say that we're able to get that for 75 cents. And at the same time, we're going to buy The 45 put, that looks like it's trading around 51, 52 cents. If you'll forgive me, I'm going to do a little bit of rounding just to make the numbers easy to follow. Let's say we're able to buy that for 50 cents. So we get a little bit fortunate on the fill here. And let's just assume we buy that 19th of September, $45 put for 50 cents. So that's going to be our example trade today. We'll see if we ultimately are able to execute this for those numbers. It might be a few pennies off, but that's okay. When we're just talking about this trade, it's sometimes just helpful to just have nice round numbers. So before we, and believe me, the math, understanding the math on this is vital for planning the percentage exits we're going to be talking about. We have to know the math of how much we can make. We have to know the math of how much we can lose. And then we can use those numbers to plan the percentages for taking profits or losses. Okay. But here's what we've done. When we sell a put for 75 cents, theoretically, what we're doing is accepting a payment for 75 cents per share. These are standard contracts, 100 shares. So it's 75 cents times 100. So it's $75 that we're being paid. But in exchange, someone has the right through the 19th of September to sell shares to us for 46 bucks. That's the deal. That's the contract. Receiving $75, but we have an obligation to maybe have to buy shares for 46 if somebody else wants us to. So this contract, we're paying $50. So receiving 75, spending 50. But in this case, we're spending 50 bucks, and that gives us the right to sell shares for 45. So let's just sort of run through these numbers and understand the math of what we're dialing into or what we're getting into. So let's talk about the fun part first. How much can we make on this trade? If this trade goes optimally well, what is the theoretical maximum gain on this trade? Well, we're collecting $75, spending 50. That gives us a net credit. This is also our maximum gain here, a net credit of 25 cents or $25 on the 100 shares here. That is our maximum theoretical gain on this trade. How much is the most we could lose on this trade? Well, our theoretical maximum loss would occur if we were ultimately required to buy shares for 46 and sell those shares for 45. That would be a $1 loss, but we did collect 25 cents to set this whole deal up. It leaves us with 75 cents of loss potential on this trade. So yes, this is one of those strategies where there's less opportunity or there's a lower reward potential than there is a risk potential. And that's because there's a high probability of success and a low probability of failure. It's the teeter-totter effect that we talk about every week in these discussions. When we talk about spread trades, there is a teeter-totter effect. When the reward potential goes down, the probability of success goes up and vice versa. So that's the math of these. Let's talk about how those actually might be realized. The ultimate purpose here of this trade, what we'd really like to see is for the stock to be above our vertical spread. So remember, our vertical spread is down here at 46 and 45. Look at where the stock is right now. We're already well above 45. We're at 40 or at 46. We're at 47 and a half. We really want to stay, as a key, we want to stay above 46. That's where the trader wants to be. And that's where we are. Where we don't want to be is down here. As we get toward that September expiration. So let me just make that into a pink box. This is our no-fly zone. We don't want to go there. So we're already where we'd like to be. And all we need the stock to do is, if it goes up, great. That just makes the scenario even better. If it comes down, that's okay. We're still above 46 as long as we don't go down below 46. If we're up there above 46 at expiration, we can talk ourselves through what would happen at expiration. This is almost certainly what would happen. There can be rare exceptions. But Myron says, where'd you come up with the $1? So Myron, let's talk about that right now. Okay. Let's say that the stock just stays right where it is. Doesn't go anywhere, because it doesn't really matter too much if it goes up a bit, down a bit, whatever. Let's just say it stays where it is, around 47.5. And September 19th, we're still at 47.5. What would happen with these contracts? We have these contracts that expire on September 19th. Well, someone has the right to sell shares to us for $46. If those shares are worth 47.5 on September 19th, do they have much motivation to undercut themselves and sell those shares to us for 46? Nope. They could if they wanted to. Sure, twist my arm, make me underpay for shares by $1.50. But most likely, this contract just expires. They don't exercise, they don't assign that contract. Well, if that expires, we had to keep the 75 cents. Awesome. But at the same time, we have the right to sell shares to someone else for $45. The shares are worth 47.5. Do we want to sell it to somebody else for 45? No. So our investment of 50 cents just expires worthless as well. So if we collected 75 cents and that's now a realized gain, but we spent 50 cents and that's a realized loss, how much did we net just leaving commissions out of this equation? We made our 25 cents or $25. That's a realized gain in this scenario. And that is the most likely outcome. Not entirely 100% certain, but a high probability that's exactly what happens if we're still above $46 at expiration. Well, now to go to the question, where'd the $1 come from? What if that's not what happens? What if the stock goes like this? Oops, I don't want to draw into the box. Let me get rid of this one. I remove that. I'm going to switch my drawing tool to a line. Let's say we collapse in value down to $44 and we hit September 19th. Well, stock's only worth 44. Someone has the right to sell it to us for 46. Guess what they're going to do? With very, very rare exceptions, they sell those shares to us for 46 because they can't get $46 anywhere else. Great. So now we're stuck with a $44 stock. We had to pay $46 for it. What might we do at that point? Hey, oh yeah, that's right. We have the right we don't have to hang on to those shares at 44. We can sell them for 45. It's not awesome, but it's better than holding on at 44. So we're stuck with the shares at 46. We unload those shares at 45 according to our contractual right. And we have a $1 loss. Now, we kept the net credit of 25 cents that we can apply against that $1 loss, but that still creates our $75 maximum loss here, maximum theoretical loss. So that is how this trade goes wrong. Now, we definitely have to be aware there is a third potential outcome. What if we wind up in between? What if we're at 45.5-ish, in between our strikes? Here's what can happen there. If we allow this thing to get all the way to expiration, and we're in between those two strikes, here's what almost certainly happens. This contract expires worthless. Awesome. We don't have to buy the shares, except while we were asleep at the wheel, we accidentally sell those shares that we don't own for $45. And it could leave us in a short position, a short stock position. So yeah, if we're in between our strikes and expiration is approaching, trader might want to keep an eye on that, maybe exit the contracts unless they want to go short on the stock. Just to give you a heads up, among many other considerations when shorting stock, it has unlimited risk potential. So maybe really understand what we're getting ourselves into before getting into a short stock position. All right, but those are our three outcomes. Both contracts expire worthless, both contracts are assigned and exercised, or one contract is exercised. Our contract is exercised and the others, the short is not. So maybe rather than just waiting till expiration to see what happens, maybe the trader wants to plan in advance. So let's make a plan to manage our profits or losses in advance of expiration. And we're going to mechanize that, automate that to the fullest extent possible through order placement. Myron, does that make sense? Good. Yeah. So our trader has done the math here. They can see, okay, I can make 25 cents or I could lose 75 cents. Quite commonly, traders will say, you know what, if I could just make some of that 25 cents and get out of this thing before expiration, I'd be happy with that. But if it starts to fail, maybe I don't want to lose the full 75 cents. And maybe I want to have a plan to minimize that risk as well. So here are just some example percentages that some traders will use. First thing is that since this is a lower reward, higher risk trade, that the traders who are planning to get out before expiration, they might still want to try to maximize that reward potential as much as possible. So instead of saying, like, oh, I'll get in for 25 cents, and if I can just even make a fraction of that, which may be only a few pennies, maybe they say something like, I'll get out if I can make at least 80% of my 25 cents. What does that mean? What is 80% of 25 cents? That is a 20% profit. Okay. Now, at the same time, a trader might try to minimize the damage exposure because there's a small reward potential, a larger risk potential. Here's an example percentage for, let's say, a trader who sees a trade that's going wrong and they just want to try to cut that off. Maybe instead of waiting and seeing, maybe they lose the whole 75 cents as a theoretical worst case outcome. What if they try to cut that in half, 50%? That would be, what's 50% of 75 cents? That's going to be around 37, 38 cents. Let's say that they want to cut their loss to just, let's call it 37 cents. Okay. That's going to be right at about 50%. Yes, some of you are going to say, actually 50% is 37 and a half cents. I had to round it up or down, one way or the other. So let's just say we're trying to fall on the lighter side of damage there. So that's our trader's plan. If this trade goes well, rather than waiting to try to squeeze every penny out of it, if there's some opportunity between now and expiration to get out for a 20-cent profit, let's do that. On the other hand, if the stock starts falling and we're starting to go down toward getting possibly a short position or just losing the whole 75 cents, maybe we just want to pull the plug. We thought we were going to be making money. We're losing money. That's not the purpose of this exercise. So let's pull the plug if a 37-cent loss has started to be built into this trade. How do we put those plans into practice? Well, here's the math of that. If we've received a net credit of 25 cents and we want to keep 20 cents of that, how much is the most that we can spend to get out? Exit at what price? 5 cents. Does that make sense? If we've collected 25 cents and we want to keep 20 cents, then we're going to put in an exit at 5 cents. If we sold for 25 cents to get in, we're going to spend not more than 5 cents to get back out of this trade. And we can put that in as an order. All right, for a maximum theoretical loss, we have to reverse our logic here. If we receive 25 cents to get into this trade, how much is the most we can spend? How much is the most we can spend to get out with not more than 37 cents of loss? Do the math there. This is going to be our 25-cent original credit. We're going to add 37 cents, and that's going to give us, what is that, 62 cents? I'll work that math backwards. Write this in here. Exit at 25 plus 37 is 62. So to reverse engineer that math, if down the road, if we have to pay 62 cents to buy out of this vertical spread, and we only receive 25 cents to get into this vertical spread, what would be the loss there? 62 minus 35 or 25 is 37 cents. There we go. So yeah, we want to put in an order to get out if we can do it for 5 cents on the positive side, or an order to get out for 62 cents and take our lumps at a 37-cent loss. That's the math here for this trade. So how do we put that into practice? We go to our trade tab, and let's put it all together here. I'm going to go down to the 19th of September. Let's go to our 46.45. I might have to, actually, maybe we can get, no, I don't think we can get it done for 23 cents. That's okay. I'm going to change the numbers just slightly here to see if we can get this to work. But a quick way to place this order is to come up here where it says spread single. I'm going to change that to vertical, and that just pairs up the 45 with the 46. And you can see we're probably not going to be able to get a full 25-cent credit. Maybe. It's probably going to be somewhere between 22 and 25. Let me click on this. This is going to give us an opportunity for some repetition, by the way. Okay. Let's, for this example trade, we're looking at about 75, maybe $77 of risk per contract. How about if we did 10 contracts here? Oops, wrong direction. There we go. Let's do 10 contracts of the 46, 45 put spread. Maybe we can get 23 cents instead of 25. So now let's see if we can use that math. We're going to have to do the math again, adjust it by a couple of pennies, and let's put in an order to take profits or to take losses. So here's the first step in placing those closing orders. Right now, we're only set up to do a single order. Well, I want to do 3 orders, one to get in, one to get out with profit, one to get out with loss. So instead of doing a single order, we're going to do a first triggers OCO order. And Joe, yeah, James is helping you out with that. Very good. Thank you, James. But we're going to use our advanced order type first triggers OCO. It means our first order, if it fills, will trigger 2 other orders to go into effect. One for profits, one for losses, but we only want one of those ultimately to be filled. If we're able to take profits, we want to cancel the loss order. If we are stuck with the losses, we want to cancel that profit order. So this is going to allow us to add 2 other orders. Now, once we've selected this order type, right-click on the original and create an opposite. That's to get us out. Right-click on the original and create an opposite. That's also to get us out, once with profits, once with losses. Okay, so this first exit order is going to be to take our losses. Let's do, to take our profits. Let's do the math on this. If we've collected a credit of 23 cents and we want to get out while retaining at least 80% of 23 cents, what is that? Let's come up here. I'm going to use a calculator. 23 cents times 0.2 is still right around 5 cents. I'm going to call it 4 cents. I'm going to put in a good till canceled limit order for 4 cents. That means if this order gets filled, we wind up buying out of this contract for 4 cents as a maximum. That would leave us with at least 19 cents of the original 23 that was collected. That's 80% of that original credit. Now, what about our losses? Let's change this to a stop order. Stop the bleeding. Good till canceled. How much is the most that we could spend? If we have a dollar-wide spread, 23-cent credit, that's actually leaving 77 cents of risk. Half of that is going to be about 39 cents. So let's put in our stop with a 39-cent loss. Now we don't just put in 39 here, because that would be, we got a credit of 23 cents. We're out at 39 cents. That would actually only be a 16-cent loss. It's 23 plus 39. So what is that, 72? There we go. So once again, if we receive a credit of 23 and oops, we have to pay, did I do my math right there? Have to double check. That's 49 cents, isn't it? 62 cents. We ever want to double check our math, come over here. We have 77 cents of risk exposure. Let's divide that by 2. We're trying to cut it in half, so about 39 cents. So 39 cents plus our original credit of 23 cents is going to be 62 cents. That's where that number comes from. Or if we reverse that math, if we have to buy out for 62 cents and we only receive an original credit of 23 cents, that would be a 39-cent loss. What would be the corresponding percentage on the loss side to break even? So that would be if we only stood to make 19 cents, then we just have to do a 19-cent stop loss, whatever percentage that would be. 19 cents of 77. In any case, or 19 cents of 23 would be about 80% additional, right? In any case, let me just click confirm and send. Now notice I have our order to get in, just good for the day. The other 2 orders are good till canceled, so they don't just expire at the end of the day. And then we click confirm and send. So there we go. So guys, as we place this order, I just want to say sometimes I get questions in the comments of YouTube, and it'll sound like a simple question. How would I do an order to get out with, like, based on profit and loss percentages? That sounds simple. That took me a full webcast to really explain how to do that correctly. But in any case, yeah, we're going to sell this, trying to get a 23-cent credit. We'll be buying out to take profits at 4 cents or less. That's our limit. Buying out to stem the bleeding at 62 cents. That's our trigger. But we need to remember that a stop order is not a guarantee that we will exit at exactly that price. If the stock is falling fast, it might cost us more than 62 cents. That just, if it starts to cost 62 cents or more to exit, we might have to wind up paying them more. All right. Due to potentially wide markets or liquidity risks at the time of activation of the stop, this order may be manually substituted with a limit order upon activation and worked until filled. Now, there are commissions to be considered here. So that chips into the initial credit potential of the trade. It can also increase the cost to close the trade out. But let's send that order off. And hey, look at that. Sold it right at 23 cents. Guys, we have accomplished what we set out to do today. DDP says, okay, let me ask another why. Why did we pick $1 instead of $5? That's another good question. Strike selection is a whole discussion unto itself. Had we gone with a wider spread, we would have been able to keep more credit, but at a larger associated risk. So the trader has to just weigh the pros and the cons of those. That's the short answer to that question. We'll explore that in greater detail. Or what might a trader do if they have a question about about strike selection? Go watch the archives where we address that specifically. So make sure, if you haven't done this already, that you are subscribed to our Trader Talks channel. You can go down and click on that subscribe button right now. It doesn't cost anything, literally only takes a second. But on our Trader Talks Schwab Coaching webcast page, we can do, let's see if someone has cleverly titled their strike selection. Look at that. The surprising importance of strike selection in vertical spreads. So yeah, if you want to see a real answer to that question that you just posed, that would be the way to find that answer. All right. Everybody, hey, thanks for giving me your time today. James, thanks for helping out in chat. I'm going to be doing another webcast in just a few hours. I'm going to be delivering the swing trading discussion in actually a couple of hours, so I'll look forward to seeing you there. But I want to make some reminders of the resources that we have available to you outside of these live streams. As I've mentioned, make sure that you are subscribed to our Trader Talks channel on YouTube, but also make sure that you're following your favorite presenters on X. X is the best place to connect with us in between these live streams. You can find James on X at James Boyd CS. You can find me on X at Cameron May CS. There's my handle. But yeah, this is where I can post things like, today it was kind of a funny observation, but I just read that dial-up service for internet connection is just being discontinued as of September 30th. I thought I would have guessed that was discontinued 10 years ago, but nope. AOL still been delivering dial-up, still continues delivering dial-up until September 30th. I got bad news for you. For those of you who heard that annoying tone to join today's webcast, you're going to have to find a different connection service. Anyway, yeah, people have been replying to that. I've been replying back to them. If you reply to one of my posts on X, I try to reply right back to you. Typically 15 to 20 back and forth replies. But it's the best place to connect with me in between these live streams. Between 15 and 20 of those per day is sort of my average. So Noodlebrain says, love the training. Hard to follow along with scattered on YouTube, though. You have like 2,000 videos, overwhelming. Yeah. So Noodlebrains, I definitely have a suggestion for you there. If you have something specific, like let's say you're just learning about options trading or you're just learning about charting, right here at the top of our playlists are a series of organized lessons before you sort of launch off into the more scattered discussions where we're just applying more different topics. Right up at the top, you'll see a series right here that says start here to learn about options or trading options. So if I click on that, it takes you through a series of lessons. 1, 2, 3, 4, 5, and so on. Okay. If you want to learn about stock charts, well, look at this. Here's another series that I teach every week. New to thinkorswim, start here. So if I were to click on that, I see a playlist of lessons, very structured. So hopefully that's useful to you. But yeah, once you're beyond that, I think our veterans could attest to this. It's kind of nice to take different topics each week and explore those. All right. Yeah. Okay, good. You like that idea? Good. Hope that's helpful to you. Everybody, I'm going to let you go. I'm going to go prepare for my next webcast. Thank you to everybody that's already clicked the thumbs up. That's always appreciated. Got 184 people watching the live stream and 58 have already clicked the like button. If you enjoy a webcast, click that like button. Whether you're watching live or you're watching on the archive, click the like button. It helps every time. The presenter feels good to them. They see all the likes rolling in, but also gives a boost to that video in the YouTube algorithm, help more people find it. All right. So yeah, go enjoy the rest of the educational offerings today. I'll see you in a couple of hours for swing trading. I'll also look for you next Tuesday or in one of my other regularly scheduled webcasts. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.